Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to another episode of Investment Fridays with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. It is currently July 6th. We are recording for July 7th, 2023, and we're going to talk about some stuff. We actually have some questions from a listener that we will go over in the next, second half of this podcast. And as a reminder, if anyone else has questions, literally anything that pops up that you're like, I wonder if Brad could talk about this, send me an email or shoot me a message on any of the social media platforms that you might follow me on, and we'll ask Brad the questions. So Brad, welcome again. And what's up this week?
Good morning, Hannah. Lots of things. I just want to reiterate, we love questions on this podcast. So no matter if you believe it's a dumb question, there is no such thing as dumb questions, except the questions that are not asked. Mm-hmm. So we would love to hear your questions, and I would love to address them if I can. If I can't, then I will get back with you on the next podcast, because I will research the answer for you, because I love to do that.
Right. So,
Hannah, if you've been watching, things are exciting. This week in the markets, it's a holiday shortened week with the 4th of July holiday on Tuesday, but that has not stopped the economic data from coming in, and that certainly has not stopped the exciting market reactions to that data. A couple of points are economic data is coming out. It's slowing, but we're still growing in a pretty decent way. We had an ADP employment report come out today, which was almost twice as much as the expectation. So why is that important? Well, it means that there's a lot more people hiring out there and getting jobs and getting good jobs relative to what the economists expected. So what does that mean for us as investors? Well, immediately the US bond market sold off, meaning their prices went down. And so now those yields are increased because there's an inverse relationship between the two. And so now as the yields go up, people in equities in stocks start to say, well, geez, if I can get 5.5% on a 6-month US Treasury bill, why take the risk of an equity market that may pull back? They may have some volatility going forward. And so you're starting to see that pullback in equities. They've had a wonderful first half of the year from the S&P 500. So equities have done extremely well. In fact, probably better than they should have, given the context of the situation. But they had a great first half. And now in the second half, I think people are saying, yields are going up. Interest rates are more likely going up. Why own the risk of equities when I can lock in a good, sure, secure 5.5% plus on some fixed income instruments? So the equity market is selling off today relative to that. Also with the Federal Open Market Committee, it's the committee of the Federal Reserve that sets interest rate policies. The chairman of that committee, Jerome Powell, who we've discussed in the past, has come out and said, hey, we continue to believe we're going to increase interest rates at least 1 or 2 times this year between now and the end of the year. That is a surprise to market participants, because most of us thought that we were going to get to the 5 to 5.25% range, and they were going to pause and kind of see how things play out in the economy, because they raised interest rates so quickly and so much that it's tough to gauge how that's going to impact smaller companies, how that's going to impact households, how that's going to impact the housing market. We don't know, because the impact of these policy decisions take a long time to get through the entire economy. And so those variable and the variable lagged effects have yet to be seen somewhat in the real economy. But again, the financial markets are trying to adjust to that new reality, with equity markets selling off a little bit here in the third quarter, the beginning of the third quarter, and the bond markets selling off a little bit to entice more of these fixed income investors who for the past couple of years have really been in the equity market, even though they probably shouldn't have. So that is a quick market update. Any questions, Hannah, that you have?
Yeah. So the thing that was just kind of sparking for me there, I was thinking back to 2022. Remind me what the bond market did in 2022.
2022 was not a great year for bonds. It was down negative teens. So negative 13% is not a good return for any market, let alone the quote unquote safer bond market. And so it was a pretty disastrous 2022 for bonds.
And that hasn't happened. Was that since the 30s? Is that correct?
That's correct.
We've never seen that kind of down pressure on the bond market. And that was all because of the steady increase in interest rates. Maybe not all because, but primarily because of the steady increase in interest rates, which I think we mentioned this last time too. The interest rates have been increasing for 18 months at this point.
Yep.
Right.
Roughly around there.
So what we're seeing now, and this actually kind of plays in with some of the questions that we got too, is this, like you're saying, this balance in the bond versus stock markets. And I saw an article just this week that was saying that most retirees, or a lot of retirees right now, have been much more aggressive than the, typical 60-40, 60% stocks, 40% bonds portfolio of the past that was recommended when bond interest rates were higher, right? When you could reasonably assume 5, 6, 8, 10% on some bonds, you can put some of that, again, 60-40 portfolio, 40% into that part of your retirement portfolio, and it would be okay. Well, we haven't seen that. We haven't seen bond yields being high enough to support a 60-40 portfolio in quite a while now. And so we've seen a shift into equities for people who do actually need income from their portfolios, but they're still, for lack of a better term, rolling the dice. In the equity markets, more so than we've seen in the past. So do you see this as this shift into a higher interest rate environment overall, being able to balance, especially those retirement portfolios, or for more conservative investors, right? Does this start to give us some sense of a shift back towards more balance?
Absolutely. I mean, really, it's been since 2001, 2002 that the bond markets haven't offered a very good current yield, meaning the interest rate that you're receiving from your bonds hasn't been really that good, and so they've been, and for the most part, a lot during that time, the Federal Reserve was suppressing yields. They were keeping them down to help the economy heal from a couple of different crises during those times. And so you had these lower than normal yields. And so people that couldn't live on that yield had to search for return in other places. And one of the places they did was trying to find higher dividend stocks that would pay them enough to do that. So you have a group of marginal buyers or marginal investors in stock that probably otherwise wouldn't have been there during that time frame. Now, fast forward 20 years, here we are in 2023, where yields are getting to the point where they're pretty attractive from a short-term and intermediate term perspective, particularly as inflation comes down and continues to fall, hopefully into the target range of the Federal Reserve eventually. But that marginal group of buyers are right now doing the math. They're trying to figure out, is this time to step out of stock and into these bond yields that I can lock in 5-6% for a 10-year corporate bond, or a similar muni bond with a tax equivalent yield in the 5.5 to 6 range. Is that good enough to entice me to sell my stock? For certain people, it is. And you're going to start to see that rotation, from a heavy stock portfolio back to more of a balanced portfolio. In fact, the Wall Street Journal, I don't know if that's the article you're referring to, but they did a study and they said, I think Vanguard did a study, and there's a number of 20% of people over 80 years old have a majority of their portfolios in stock.
Yeah, that is the study.
That's okay. So historically, that has never occurred. I mean, you have, some of the older couples or gentlemen or women who, are risk tolerant. They're gonna bet the farm forever, and good for them because they can handle it, I guess. But most people are not risk tolerant. In fact, they're risk averse. So as they get older, particularly, they become more risk averse because the volatility in those assets really starts to bother them. They want to lock in that steady income. And that's where today you're going to see a lot of those individuals and families shifting a little bit more into the bond era or the bond area from stocks.
So what's interesting to me, seeing this information, first, partially in hindsight, because we've got some data from last year, and then what's continuing to happen this year as well, it almost feels as if that cratering of the bond market was necessary in order to allow yields to come back up to this more normal level, right? Where if you lend someone money, which a bond, right, is you're lending this institution or municipality money, and they're going to pay you back in full over time, you expect to be paid a percentage for that. And it just wasn't there for so long. There was hardly any yield. So yeah, it's interesting how big the shift was, but I don't know if we would have gotten there necessarily if we wouldn't, right? If it didn't come down 13% last year.
It was absolutely necessary to take that over time. It had to adjust back to more normal levels. And I think that's one of what Jerome Powell is trying, and the Federal Open Market Committee is trying to do, is take away that zero interest rate policy, which they implemented for a very, very long time, where, hey, we're at 0 to 25 basis points or at 0 to 0.25% on the Fed funds rate, which effectively takes short-term rates so low that across the yield curve, it makes yields very unattractive. One of the things that I think they did, and I think that historians and economic historians will have to work this out, is how fast they did it and how long they waited to do it. And that's where they got into trouble, is they waited too long. Had they acted sooner, they could have drawn this out over a couple of years instead of boom, percent all within 18 months. I mean, that was a very fast rate. In fact, it's the fastest rate since 1994. And because it was the rapidity of that interest rate increases, that's what caught some of the banks that we had earlier this year in the spring. That's what caught them off guard, and they were not able to adjust their balance sheets for that risk, and consequently are no longer in business.
Interesting. So this it's a little bit of a side into this, but I want to bring in the topic of market breadth again. So let's kind of tie that in as well, because even though we're seeing a little bit of a pullback today, we still, what we've talked about the last couple of months as well, the top 6 or 7 stocks in the S&P 500. So those really mega cap tech stocks, we all know what we're talking about, are the ones that have been driving the vast majority of the returns in the entire, stock market so far this year. And some of the questions that I've been getting about that from people have been, well, is this real then? Is it real if 493 of the top 500 largest companies in the US are not really participating in this market rally? Is it real? And so what nuances do we have on that this month that we maybe didn't have last month or the month before?
First of all, I share their concerns. I'm going to go through the negative of it, and then I'm going to walk through kind of maybe why I think it's not going to be disastrous for the US. Okay.
Great.
One is 7 stocks on average, 82% through the first 6 months of this year. Okay. Amazing. Now, what we cannot forget, but people tend to do, is in 2022, they had disastrous returns. Tesla was down 2/3 of basically 67% last year, 2022, and it is done very, very well this year. Okay. But again, if you owned it if you bought it January 1st of 22, you're still down quite a bit on that position. Now, not many people buy it at the high and then hold on to it through 18 months, but a lot of those 7 stocks are up so much because of the fact they were down so much last year. Now, there are some fundamental factors that have driven, have kind of been the seed of this rally for certain stocks, like NVIDIA. NVIDIA makes the chips that really help artificial intelligence. All right. So artificial intelligence is a new wave of innovation that is going to disperse itself throughout the US and the global economy. So NVIDIA is in the, kind of in the seat of, oh yeah, we make these chips. We're the number one. And so that stock price has really up significantly, basically 200% year to date, because of that. Now, has it got ahead of itself? Probably. Even the S&P 500 itself, driven by those 7 stocks, its relative strength index got to about 70, a little over 70. That is really, really high. And it means that in the short term, we're probably going to have a pullback in that headline index, meaning those top 7 stocks. So that, coupled with the valuation of these stocks, is pretty heady right now. So in those 7 stocks, which, I think investors used as hey, they sold off so much, and this year, because we don't know what's really going on with the markets, we're going to buy those as a safe place, because 1, they've sold off so much, and 2, they generate a lot of free cash flow. And so we're going to go ahead and purchase those stocks because we know they're going to do well. Well, these things can go up too much. In certain respects, some of them have and some of them haven't. But it's something we need to watch out for and be a little cautious of, because the market valuation indicators are giving a warning sign of just saying, hey, maybe these 7 stocks have gone ahead of themselves year to date. And then you have interest rate increases that may be continuing to come down the pike.
Right.
And we have earnings that, based on the interest rate increases, based on a slowing economy but still growing, may not materialize as much as we would like. So cautious on those 7. Okay. Everyone else, I think, is in a good place. Jerome Powell said that we're only having 1 to 2 more interest rate increases, and they're going to see how those are rolling through the economy.
Mm.
It's really important to understand that interest rates affect every financial market instrument out there. They affect the value of every business in the world. They affect the value of every piece of real estate, every bond, everything. They are the underlying rate by which everything is valued. Okay. So it's important to understand that context. Once they pause, I think the economy is slowing, but will start to reaccelerate. The consumer is in still a very, very good place. They still have very moderate debt. Their income levels are growing pretty decently. The job market clearly has been pretty healthy for them. And so people can continue to move up that way. So what's going to happen is I think you're going to see the market broaden out, and those top 7 stocks they may come down a little bit, but on a relative basis, they're probably going to stall out in their returns for a number of months. And the smaller cohort is going to grow, and they're going to catch up with a lot of those market leaders. And that is going to increase that breadth. Okay. Because again, we said it last time, an equity market rally that has broad breadth, has a lot of stocks participating, is generally much healthier than a very, very narrow market.
Mm-hmm.
A very narrow market means very few stocks are participating. And without a broad breadth, it means maybe one industry is doing well as opposed to the broad context of the economy and the financial markets.
Yes. So to kind of sum that up, we are looking at interest rates again as a benchmark of not just what it costs to get a mortgage or a loan, or, interest rates at a bank, but truly seeing how those trickle through and affect our stock market as well, and valuations and cost of borrowing and all of that, business valuations across the board. And those top 7 stocks that have been doing phenomenally well so far this year, partially is due to the fact that they did so dismally, terribly in 2022. So that piece of context as well. And finally, that, the last 493 stocks that haven't quite participated yet so far this year in this market rally, that once we have a little more clarity on the interest rates, if they are going to have 1 more or 2 more, that we're still kind of waiting to hear from Jay Powell about this, that those might then actually pick up. So when that pause is paused, like, hey, we're going to stop here, that little bit of certainty could help those remaining stocks to lift up into the actual market rally that we've been seeing from the top 7.
Perfect. The only thing I want to put a caveat in is if these interest rates continue to going up and it creates a credit crisis in the banking industry. I don't think it will, but if it does, then you'll see the breadth broaden out, but it'll be on the downside because those 7 stocks will drop quite precipitously relative to the other stocks that haven't done nearly as well. Just because in a credit crisis, it affects all companies, it affects all asset prices, and so that would create a problem. But again, I don't see that happening. Even during the financial market turmoil, the regional banking turmoil earlier this year, the Fed stepped in, increased liquidity to make sure that those credit markets were functioning fine.
That's right. Okay, so let's go to, we have 2 questions.
Awesome.
2 questions from Bob. Bob is usually listening from Huntsville, Alabama. So hi, Bob. These are straight from him. Question for Brad. regional banks and office REITs are by and large radioactive to the general investing public. So that's his little opinion there, which we appreciate. But to the savvy investor, is that a place to find a bargain since the market in general is expensive?
Yes and no. Again, I'm a two-handed economist. So what Bob is talking about is exactly correct in the sense that anytime there's carnage in one part of a market, there is opportunity, right? It's like the Chinese symbol for risk is actually also can be interpreted as opportunity or return. So in every market turmoil, there is opportunity, and you need to be able to sift through kind of the garbage to weed out the real opportunities to take advantage of them. So, Bob, yes, there are some opportunities. However, individual investors, to gain access to those opportunities, we need to hire specialized managers who can take advantage of that opportunity. Because unless you have the expertise in office real estate, let's say, it's very difficult to discern, is this an opportunity or is this just a garbage piece of real estate that's going to have to be repurposed, and it's going to require a lot of investment capital to do that. I have a number of friends that are doing that, and they are on the hunt for looking for some of these deals. For example, roughly $300 billion in commercial real estate loans mature in 2023. Unlike a home mortgage, they're not 30-year loans. They're much, much shorter term. And when those come due, you have to re-up. You have to re-qualify for your mortgage, your commercial mortgage. And so to do that, to make the equity to loan to value ratios work, it's possible you're going to have to dump some money into it just to refinance the building you've always owned. So it can get a little frustrating for landlords or business or building owners that don't necessarily want to do that. They may think, you know what, I'm going to let this property go because it's not that great. I'm going to sell it on the market. I'm going to probably earn a little bit of money on the sale because I've owned it for at least 5 to 10 years. I'm going to take my profit out of it, let someone else finance it, and I'm going to go look for another property. Well, that is where my friends in the commercial real estate investment space are looking for those diamonds in the rough. The problem is there's a lot of rough out there. And so they are searching diligently, but to gain access to those, again, finding a good manager that can put you in to participation with that diamond in the rough, it is a very critical aspect.
So what you're saying here is that that's not necessarily like buying a regional banking ETF or buying a commercial real estate ETF. That's just really broad index based or anything like that.
No, this is instead of a shotgun approach, which would be like the ETF example you just used, this is a sniper. You're wanting to find that one building that for some reason is undervalued. You're going to buy it. You may have to inject some capital or change some things to lease it up. And that's the diamond in the rough. It's a very active investment strategy that requires changing it in some way. So a great analogy to the ETF is Class A property. Class A office property is the office property that generally you drive by that it's really well taken care of. It's usually almost always rented out. You can see lots of cars in the parking lot. Those Class A ones are kind of the ETF. You can buy and hold those, but the returns are far less. What I'm talking about is possibly the strip center or the office building that may have a few cars in the parking lot. They may have, but most of it may not be rented out currently. And it's old, kind of looks dingy. It needs some refurbishment. That is what I'm talking about. That's the kind of the rough that they're looking at every single one of those properties to determine, can I get this turned around and earn those excessive returns or excess returns by doing that. And that's right now, that's the marketplace for office right now. But for the majority of it, I would probably stay away from.
Interesting. And then what's your take on regional banks as well? That was part of the question as well.
Yeah, so regional banks, love them. Don't know if I love them right now. Until we get over and we see how the office building, because 70% of commercial real estate is financed at the regional bank level.
So
it's
they're
not
connected.
Yeah, they're connected. So it's not the Citibanks, it's not the B of A's, it's not the Wells Fargos that finance most of those loans. It's the regional banks that do that type of lending. And if it becomes a problem, it's going to become a problem not only in the office CRE space, but also in the regional bank balance sheets. And that's one of the tipping points that I'm watching very closely to see, how the delinquencies on regional banks balance sheets for office commercial real estate in particular, how many delinquencies, how fast they're growing, to see if there's going to be a problem later this year.
Interesting. We'll come back to that.
Okay, that sounds good.
Yeah, we'll keep an eye on that one. And then this one kind of goes back to the bond question of, are there investment opportunities in construction credit, especially industrial construction?
Yes, there is. Again, a lot of that lending so construction financing in general, a few banks still do it, but a lot of that lending has migrated over to private credit facilities, meaning instead of being a publicly traded bank or a private bank, it would be a fund that is set up specifically for the reason of financing construction and building.
Ooh, give us a for instance on this.
For instance, let's say I'm a developer and you're a lender, okay? And I'm thinking about building a warehouse, not even a warehouse. Let's say a factory in downtown Cincinnati. Found a good building, but I need to kind of renovate the whole thing. So it's almost like a knockdown and rebuild. So I go to you and I say, hey, this is what I want to do. And based on history, based on everything, you're going to analyze my situation and the project and determine whether it's financeable or not. Now, at a bank, you have regulations that determine what you can finance and what you cannot. At a private fund that is specifically set up for these type of financings, you don't necessarily have that issue. It's not, you don't have to, you have a lot more freedom in what kind of lending standards you require. And so that is a lot of the construction financing per se has migrated to funds, which you can get them done. It's just at a little bit higher cost. And it may be the credit monitoring may be a little different than you're used to at a bank.
Interesting.
So yeah. So again, these historically have been the more aggressive, which is why banks don't tend to like to do construction credit anymore, is because they're riskier. And so if you don't want to have a lot of risk on your balance sheet as a bank, then that may not be a good piece of business to do for you to do. Whereas a fund where people are investing money, commingling that money into a pool, and they're patient, right? They're looking for returns on an annual basis. They're investors, they're long-term in nature. It's not based on depositors' funds to fund that construction credit. So because that pool has their investors are longer term in nature, they can be patient with that construction credit. So if you notice, the riskier lending businesses have gone towards the private funds, oil and gas, construction credit, some of those types of issues have gone to private funds, whereas regulated banks have kind of shied away from that. Similar with agriculture as well.
So would that be more in the, what do you want to call that? Just private investment market?
100%. Yep.
Okay.
That's the private credit market altogether. In fact, it really got a boost. Private credit's been around for a very long time. But really after the 2008, 2009 issue with the banks, it grew substantially, particularly as oil and gas companies started getting their funding cut off. So if you don't remember, back then, oil prices were low. It was very difficult for an oil company to get a loan. So, that type of credit migrated to the private world and has done very, very well since.
Interesting. Well, those are the questions that we had for today. And I feel like we went through a lot.
We did go through a lot.
We went through a lot of stuff today. So yeah, I think that's a really good place to pause. And like you said, it's been a short trading week. They had a half day on Monday, market closed on Tuesday. So we've got Wednesday, Thursday, Friday. We'll see how the week closes up, but this is the first week of Q3. So that seems crazy also.
Yes.
How did we get here?
2023 is going very, very quickly.
Yes.
It seems to be anyways. I don't know about anybody else, but I think it's flying. So
yeah, I feel that. I am feeling that so much right now. So again, we're going to do this every single month. If you have any questions, send them our way. And if we don't have answers immediately, if you send them ahead of time, we will have answers because we'll have time to research. But yes, we love doing that research for you, and let us know what you think. And if anything sparks your interest and you want to learn more, don't hesitate to reach out to me or to Brad directly at Juncture Wealth Strategies. So thanks again for being here, and we will see you next month.
Sounds great.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, @expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.